Hello and welcome back to The Note, back in New York today, where markets are back where they were at the morning yesterday before we heard from Janet Yellen telling us that she was not impatient to raise rates. Now, in between, there has been quite a dramatic round trip, perhaps most noticeably in the dollar. It fell on a trade-weighted basis more than 3% after Janet Yellen spoke, and it regained some 2.7% today. Quite a remarkable round trip. Now let's take a look at stocks and oil. You can see that the S&P 500 also rallied very impressively after Janet Yellen's words and has given a lot of that back today. Perhaps most remarkably, take a look at oil, in many ways regarded as the inverse of the dollar. Rallied 7.9% at one point after Janet Yellen spoke on Wednesday, and at one point today it gave back 5.5%. Quite a remarkable round trip, but the final analysis, after people had digested exactly what Janet Yellen told us, is that we're roughly where we started. The drama of Wednesday told us more about how people were positioned, how they were overexposed, than it's told us about anything new from the Federal Reserve. If you want a picture of where the market is with regard to the Fed and the possibility of higher rates, that's perhaps best to look at this. This shows you the expected Fed funds rate as of October of this year, as derived from the Fed funds futures market. You can see that in the summer of 2013, during the so-called taper tantrum, after Ben Bernanke started talking about tapering off QE bond purchases, people were expecting rates of more than 1% by the autumn of this year. At this point, implicitly, there's really only about a 50-50 chance that we get a rise to 0.5% by October of this year. That's quite a shift steadily over time, even as markets have become more convinced that the Fed is going to be raising rates. They are also becoming more convinced that those rates will be slower and lower than they had initially feared. Now, from the point of view of the Fed managing expectations, this is plainly very good. They have managed to keep everybody calm. That diminishes any risk of a big crisis in the short term. In the longer term, plainly, it's got to be some concern that it's that important to keep the market calm. It's got to be some concern that people still feel this kind of a need to keep rates so low for so long. But for now, after 24 hours or so of drama, we're back where we were on Wednesday.